Hi there, traders. This is Brad Gilbert with the Daily Market Insight for Monday, the 4th of October. All right. Now, as we tune into non-farm payrolls week, right, it's going to be a major focus, especially once we hit Wednesday, Thursday, in particular in the US. It's all the talk's going to be about, what a strong non-farm payrolls number does for us. Now, we've seen things settle down, right? We saw the US bonds last week shoot to the top side. They've pulled back, but they've settled at a base much higher than where it was previously. So that's something that's sort of solid that we can sort of hang on to. The equity markets on Friday had a pretty good day, US equities. So there's still a bit of work to be done. The US equity futures, right through that Asian session, have come off like NASDAQ 0.5%. That's something to sort of talk about. But what we're seeing across the board is, we've got this sort of uptrend here in the dollar index, right? Now, I think the underlying bid tone, right, upward tone from the US bond market should maintain that. It's all going to come down to the data that comes out this week, and most importantly, the non-farm payrolls on Friday. Now, let's just have a look at the charts. And what I've done is I've just overlaid the US 10 years on a lot of these charts, okay, just to give you a bit of an idea how the correlation, how the US bond market is impacting a lot of these pairs. Now, the dollar pairs at the top here, right? I've got it just naturally overlays because the US dollar is the base currency. You can see dollar yen, basically it's going in and out of the correlation very quickly, but you know what? The US bonds seem to be running roughshod over dollar yen, right? Directing where things are. So that can give you some insight into what's going on there. Dollar Swiss also not as continuous, but once again, the same thing. You'd expect this on the dollar pairs in particular. Now, the dollar index also following the shape of those US 10 years, the yields. So what we've got is, then you come down here. What I've done on the dollar block, Euro, Sterling, Aussie, and Kiwi, I've inverted the bond price, right? The bond prices. So what I've got here is, the yield, I should say. So I'm just looking at the wrong screen. And as you can see, it is like the euro is following the US 10 years, as is sterling to a point. Aussie, well, it's really overshot the mark, and the Kiwi is right on the money. So this tells me overall, we've got to keep a very close eye on the US bond market this week. Obviously, you can see it's impacting the major currency pairs. It doesn't do this all the time, right? And when you've got a clear sort of, and use the US bond market as an indicator for price direction. Now, most importantly, when I talk about this, indicators, right? They just indicate where it's going. It's not an absolute science of, it goes pip for pip. So don't get stuck just watching the bond prices and think, dollar yen's going to go up or down, depending on what this does pip for pip, right? Over the course of the day, it does shape the direction of what the dollar's doing against various currencies at this point. So it is important, but being a screen watcher and a price watcher can be problematic, because this thing will go, the yields, right, will go up and down like normal price action on all the other instruments. So you could be sitting there thinking, this has gone up 5 points, I'll jump in, and then next thing it goes down 5 points and you're out, in and out, in and out, right? It can be problematic. What we're looking for as an indication are the bond yields going up or down over the course of the day. If they are, it should support the dollar. If it's down, well, then the dollar may come under a bit of pressure. That's what you've got to do here with that. Now, it's a bit of an interesting one, right? So you think this is a bit of a risk-off profile, okay, to start the week, US equity futures, but in actual fact, the dollar block are up and the dollar pairs are down, with dollar yen being the odd one out. It's sort of just sitting there sideways. So at the moment, the markets are reconnecting after the weekend, right? There's obviously going to be a lot of focus on Friday's numbers. So not many traders would be rushing in just yet to sort of jump on board and go mad. What you want to do is let the markets connect or reconnect after the weekend, see where the dollar sits, then have a good look through your fundamental economic calendar, right? You got some factory orders, good number here to sort of kick the week off as far as like the US dollar, and then just scroll down through the calendar and see if there's any sort of focal points that you could, that we could potentially get momentum shifts in some of these currency pairs, right? And it's the start of a new month. So there's going to be data everywhere. We've got the RBA on Tuesday. We've got a bunch of European data as well tomorrow. Okay, some PMI data across the board. So, a bit of a lead into what's going on. Trade balance figures out of Canada. No big deal. Don't get excited about that. Get the final PMI numbers here. Usually not a lot in that, but the ISM manufacturing numbers, definitely something to keep one eye on there. We've got the RBNZ cash rate decision as well, right? So this is going to be important. Before the lockdowns, the RBNZ was ready to raise rates. Now, from what we've heard, I don't think there's any chance of that happening, right? So, but anyway, that's going to be an important event to focus on. Retail sales out of the Eurozone as well. Then we come into the first of the employment numbers, the ADP national employment. Now, there's no sort of clear correlation between that number and the non-farm payrolls, but you know what? We watch them all anyway. And then you come down through, you get the weekly jobless claims, right? Now, once again, that could be up or down with the non-farm payrolls. And then when you get to Friday as well, now we've got the big kicker. And this is, as I said, going to be the primary focus. The Federal Reserve has been talking about, tapering asset purchases. They're talking about maximum employment. We get strong numbers here, right? That's where the answer is going to be. And right, and this is, I think it's so, like the Fed's been pushed into a bit of a corner. If the numbers are strong, right, what we're talking about is the unemployment rate. You want at least these two numbers, the non-farm payrolls to be stronger, the unemployment rate to be better than 5.2%. We want those two. Now, on top of that, ideally, the average earnings as well is going to be a focal point. But I'll be discussing this come Wednesday, Thursday, and most importantly, Friday. It's huge. It could give us direction for the dollar for the coming, the rest of the year, right? Hit October, November, slide into December with a strong dollar. It's going to be easy to pick off the currencies if that's the case. But the fact is, where the dollar is at the moment, even if those numbers are really weak, I think we've got a situation on a lot of these pairs where the dollar is being factored in as going up. So the dollar block all down. I mean, the Aussie's retraced, but you know what? It's going to be a situation where if those numbers are weak, we could have some good trades on the downside of the dollar, as there's a lot of unwinding here. And what will be unwound is the big, very aggressive move on the US bond yields, right? They will come off aggressively. That'll drive the dollar lower. We should be able to make cash either way, right? But it's a long way to wait till Friday. So have a look through your calendar, see if anything makes sense. In the lead up to a big number on a Friday, your job is, right ahead of this, is to try and add some cash to your account, right? The big trade is going to be after the non-farm payrolls, right? So you don't want to go into the non-farm payrolls losing money this week beforehand. So take it easy with your early trading. Try and bank some cash. It doesn't necessarily need to be on a dollar pair, right? If you can see some activity, some opportunities on any of the instruments, well, then lock the cash in. But what I'm trying to say is don't overexert your risk, because you want to save your dollars for Friday's releases. And actually, you know what? Even if you don't want to trade the non-farm payrolls, which we know can be problematic because there's so many variables, it's the trade afterwards. Even if it's only 10 minutes afterwards, we'll know what's going on, where the direction for the dollar is, right? One way or the other. And that's where the best trade will be, right? Our worst case scenario is something as expected for the non-farm payrolls. That blows us all out. You know, all the bulls and bears will be like sitting down fuming, but we'll deal with that when we get to it. All right, guys, big week ahead. Loads of stuff coming out. What I would advise you to do, have an experiment with your charts, right? I've overlaid the US 10-year Treasury bonds here on my charts. Try doing that. Try overlaying other instruments. See if there's other correlations in play that may actually be even more tangible, right? Get to work, tune up your trend lines, and get ready to trade. All right, guys, have a good week. Cheerio.